Good evening, ladies and gentlemen. Welcome back to Walk the Block, where we are navigating digital finance all together. Well, not to bury the lead, but yep, the Federal Reserve did it. They finally cut rates for the first time this year, and we're going to be discussing all of what that means and whether we got what we intended or did not foresee and what's coming for the rest of the year. Because keep in mind, we still got 2 more meetings. So I know the calendar says there's only 3 months left, but that is plenty of time for a lot of stuff to happen. So don't worry about it for a second. Outside of that, yes, there is a little bit of downturn in the market today, at least from the crypto side of standpoints, which is a little bit different from the S&P 500, which, by the way, new all-time high again. So congrats to the TradFi folks while all the other crypto guys are trying to figure out what the heck is going on over here. But outside of that, yes, that is what we're talking about tonight. Federal Reserve, liquidations, and a little bit of macro and traditional finance advice that we've been hearing through the rumor mill about what's going on. But outside of that, hello, I'm Zenith. Welcome back. It's a pleasure to have you guys here, and I'm joined by an excellent cast of the team tonight. We got up first, Tracker. How you doing, buddy?
Doing well, man. As always, looking forward to Mondays. I know everybody's a little bit uneasy on what's going on. Is this just the pullback before the rise, or is this the beginning of the downturn? And we shall dive into it. It's going to be fun.
That's true. And of course, we're also joined by Dace. How you doing, buddy?
I'm well, sir. Good to see you guys. Always a pleasure to be here. Yeah, it was a busy day today. Happy to cap it off with you guys, as always.
Of course. It's a good way to start the work week, and we hope that you guys think so as well. And by the way, thank you all for showing up and joining us. We got excellent folks out there tonight. Mr. Moonpill, Rational Optics. This is Get Ready for the Money Printers Walkers, and our good friend Centurion 54X. I haven't been locked in the last few weeks, but I was hearing 113K was an important support level. Looking forward to the Bitcoin TA. If you have time, can we also take a look at Sonic too? I'll see if we have time for Sonic. But yes, Sonic had an interesting event on the charts. It is a continuation of Phantom, but as far as the Sonic chart itself goes, Sonic was launched back in earlier this year. So it did make a new all-time low on the chart by a couple percentage points, but it's nothing too catastrophic in my personal opinion. But if we have time, we'll definitely take a look at that one as well. All right, gentlemen. Well, with that being said, let's get into it. First and foremost, we have a little something called the Federal Reserve Federal Open Market Committee meeting that happened. We have the press conference here pulled up for you. But real quick, let's take a look and see what they said is going on. Look at this. In support of its goals and in light of the shift in the balance of risks, this is them talking about the job market having more risk in it, the committee decided to lower the target range for the federal funds rate by 0.25 percentage point to 4 to 4.25%. So there you go. That's the headline news right there. We've been waiting for this literally since the end of 2024 when they were talking about doing 4 rate cuts this year. Instead, we have this one in September. Yes, that is what the calendar says. But either way, let's get into what the press conference is. I got 2 clips I want to show you guys tonight. These are some of the highlights. Overall, it was a decent press conference. There was the classic bout of questions asking Jerome Powell, are you going to step down? Is the Federal Reserve politicized? And he just looked at people and said, yeah, I'm not going to comment on that. And then kind of looked at them like they were stupid. But that's neither here nor there. First up, here we go. Let's see what the man has to say. Please let me know if you cannot hear, and I will try to fix.
Thanks, Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think 0.25 percentage point now is going to arrest that?
Well, I didn't say that I thought 0.25 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
All right, there you go. So Jerome Powell got the question, why do you think a quarter point cut is going to fix all these things that you're citing? And the key word for me on this one was he talks about the rate path. A path would indicate that there's more than one decision point. So with that being said, I think it's gotten everyone speculating about whether or not we're going to get more cuts into the future. And based on what he's saying here, he's even calling out the market a little bit, saying, I don't endorse what you guys do at all. But yeah, it sounds like there's probably more to come, considering they're trying to make a change and they went for the smallest possible change they could do. What do you guys think about that?
I think the guy asked a great question. And I think the obfuscation of the direct answer is telling in the value and the potency of the question, right? The short answer he could have given is it's not. And he did say this first. He said, I didn't expect it to do so. I think it's very difficult in Jerome's position to answer that question and not be read as dovish, as saying, well, just wait a little while longer. We're going to cut it some more. And that's what you're looking for if you're in the guy asking the question seat. And so kudos to the journalist there that did his job for sure.
Definitely one of the good ones. But I can't remember if it was on this one or DGen Roundtable. We were talking about, there was kind of a commotion online about, are people expecting a quarter point or a half point cut for the first cut of 2025? And well, the answer is quarter point cut. As we looked at the data when we went into the meeting, the half point cut, based on the futures market by the CME group and their FedWatch tool, it had it at about 5% or slightly less. So I think overall, the cooler heads did prevail on this one, which kind of is the name of the game. And they ended up being right. But at the same time, now we're looking at the rest of the futures markets and whatnot. Yes, we are still a ways away and things can drastically change between now and then, but it looks like quarter point cut and another quarter point cut as it stands. So to give the background about what's going on here is that the last meeting we had was back on July 31st. Literally 2 days after that meeting, we had a giant revision to the jobs data for April and May. During those two revisions, there was about 250,000 jobs apiece where they overestimated the job creation. Since then, we've had more of that. At this point, for the track record of 2025, I think there's been an overestimation of almost 900,000 jobs that were not actually created, that were estimated to be created. This is also a bit of a continuation from a story that we covered back in 2024, around September, October time, where for the year of 2024, there was a similar thing as well, where for an entire calendar year, there was another overestimation of about 800,000 jobs. So what we're seeing is that the jobs market has now become more of a concern than the interest rate for the Federal Reserve, which is why we're getting the actions that we're seeing now. That being said, again, they took the smallest possible course change that they really could have. So we have a quarter point now. There's possibly more to go. The question really is, like, is this enough to change things? And also, how big of a change is needed? At this point, based on what we've seen Jerome Powell talk about in the past when it comes to the giant risk of inflation that we saw back in 2022 and 2023, there's a lot more alarm going on then. This seems like more of shifting as the tides change instead of responding to a crisis. That's what I got out of this. In fact, earlier in the press conference, he even talks. Someone asked the question, "How would you describe this change?" And they asked, "Well, like, is this risk mitigation kind of?" And he said, "Yeah, you could see it as risk mitigation. We're trying to mitigate future downside risks to the jobs market." He also talks about the unemployment rate's at 4.2% right now, and he says that is a historically low unemployment rate. So we are seeing the Federal Reserve change their tune on what is the new biggest concern that they have. And as a result, we're seeing any actions. Anything else that you guys think that they might be missing out on?
No, I don't think so. I think you summarized it well. And I think if you look at Jerome Powell's history, particularly post 2020 and giant inflation event that we all lived through, he's been very telegraphed and very methodical. Right. And that was the criticism, is that he was too slow to cut. Right. Well, now he's done it. And I have every reason to believe, because of his history and because of the personality that he is, that he'll follow through in that course, regardless, unless a giant bank goes under, unless the sky falls from a Wall Street perspective. I think he's going to stay the course. That's my opinion.
Correct. And from I largely agree with that. And from the Wall Street perspective, the sky's not falling. So I wouldn't expect any drastic rates. But I guess it's time for a little introspection or self-evaluation, which is that we've been talking for a while now about how when we finally get rate cuts, that's going to be one of the things that really pumps the markets. So we got the rate cut, but instead of going up, Bitcoin is actually down about $6,000 from where it was before the rate cuts happened. So the question there is why? And, well, I'll try to answer my own question with one of the questions that the reporters actually asked inside the meeting, because I think it is highly relevant. And in my opinion, it was the standout question of the event. So let's get back to our highlights. Here we go.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large. So I wouldn't attribute macroeconomic consequences to that at this point.
All right. So the question was, you're continuing to reduce the balance sheet at the same time that you're cutting rates. Pop quiz. How many actions can the Federal Reserve realistically take?
Jack, are you there, brother? You want me to
So the actions that they can take,
they really have two things that they can do. There you go. There's one.
Cut rates, or they can print money.
Ah, there it is. There's all two
quantitative easing, but they've got a long ways to go before they can start quantitative easing. They don't need to do quantitative easing. They always eat up the rate cuts, and then once they get down to a certain point where the rate cuts, then we'll start doing we'll call it helicopter money, whatever you want to call it, quantitative easing. I just call it print more money, but. There's no need to get there. And Jerome Powell has been he's very methodical. He's a data-driven guy. He's not going to do anything rash. It's going to put them in a tight corner. It's a very tight dance that they have to maintain. So they're not going to be aggressive and take a half of a cut. They're just not. I expect them to do another quarter of a cut, another quarter of a cut. You're going to get 2 more quarter cuts going into the end of this year. And you already stated they're going to probably cut again. Maybe, I don't know, next time they have the opportunity was January, February, they're going to get another cut. And then right around the corner, May comes, he's out of there. So it's going to come down to who's really going to come in to say how aggressive the next person that comes in there. Obviously, the administration wants to cut much more aggressively because they've already stated what their agenda is. And their agenda is that we have got to restructure all this U.S. debt that they have. And there's massive amounts of debt. And they know they're trying to stimulate the housing market and get everybody else in there to try to stimulate their debt and try to help out with, looking good in the eyes of the public. But ultimately, it's to restructure the debt that they're trying to approve. Jerome's job doesn't care about the debt that everybody's trying to do. His job is to make sure that they don't cause a tsunami or absolute collapse on the whole fragile system that is because of the many reckless factors that have been done over the years, we'll say. So that's where we are.
Yeah, but you hit it right on the head there, which is that this was a rate cut. This is not quantitative easing. By definition, this is still technically quantitative tightening because they're still reducing the balance sheet there. When they increase the balance sheet, that is when they actually have the injection of capital into the markets. So is this the event that's going to skyrocket everything to the moon? No. Is this step one? Yes. That is why I still do believe this is a very big moment for what we've been waiting for a long time here. So because of that, we kind of just have to wait, exactly like you said. The interest rate cuts is a way that they can help the markets by what is effectively reducing the cost of borrowing money, meaning that if it's cheaper to borrow money, that should theoretically incentivize people to take more risks, open businesses, kind of get a little more leverage to stimulate the economy. The other half of the equation here that we have not seen is the injection of capital. So it's kind of this is an action that is really focusing on the private markets. And then once we get to the injection of capital, that's going to be where you get the real government intervention coming in there. And that is going to be, in my personal opinion, the telltale sign of, yes, asset prices are going to go up because there's more capital available. Therefore, the existing capital is going to look for a place to park it in a way to avoid the inevitable inflation.
Now, we'll say this, the thing is I find interesting is the fact that the 10-year treasury, for everybody who doesn't know, 10-year treasury drives everything. It drives what your car rate on your loan's going to be, your mortgage, everything is on 10-year treasury. For anybody who really wants to know how messed up the treasury market is, I would highly recommend you go back and look what happened in the before 2010, 2008, or actually what was the LIBOR scandal. Go look at that. Once you understand how the LIBOR scandal worked and how that was all done, you'll understand how manipulated the whole system really is. But that's here nor there. But the 10-year treasury from this year has been going down even before the rate cuts. It got up to 4.8. It got all the way down to almost 4 even. And now, I mean, we're coming up a little bit in the last few days, but that's irrelevant. What I'm saying is they're going to start cutting rates, but the 10-year treasury has already started going down before these rate cuts. So that just is a sign they're going to need to start probably cutting rates, just to add more to the fuel. But I thought that was fascinating that the 10-year treasury had already been going down from 2000, we'll say January of 2025 this year. It's been going down. It's had some bumpy moves up and down, but overall it's already going down before the rate cuts. I thought that was interesting. Most people wouldn't have thought that, but I thought it's been fascinating.
So let's review. We've got over Powell's term since 2020. We now have realized that the past few months of job reports were off by 50%. Half of the jobs that were new that they said existed, they're not there. Before that, I would argue that they started to redefine, and we had all the conversation back on the Degen Roundtable channel about what is a recession, right? We moved the goalpost about what recession is. And if you'll notice, the clip you just said, he's like, yeah, we're still reducing the balance sheet, but he seemed terrified to say so. And all you have to do is Google U.S. Treasury bond buybacks. The Fed can say they're reducing the balance sheet while the U.S. Treasury is doing stealth QE, which is buying their own bonds back. And so, yeah, it's you got to follow the bouncing ball.
It's true. Gosh, I remember back when they had the whole changing definition of what is a recession, and we were just like screaming to the high heavens, like, "No, I will not be gaslit this hard." That was
well. Look, man, it's when you can print your money for nothing. What is it? Whose line is it anyway? The points are made up, and the points don't matter, whatever it is.
Yeah.
But yeah, it's tricky business, man. And it's funny. My X account always pops up these records of the U.S. Treasury buybacks. And then you'll watch Jerome Powell saying, yeah, we're reducing our balance sheet. And it's, what's the functional difference for the people would be my question, probably one of those reasons I'm not one of those journalists in the seat.
But here's the
That's
thing, though,
fair.
95%, 99% of people in the world are not even looking at any of this stuff. They don't even know what makes up like you said, they can change the equation. They can change what variables are being used that goes into the baskets of determining what, even inflation is. We know inflation isn't this high. We know it's more closer to probably 10 to 15% probably in the United States. And God, it's 10 times worse in some other countries, but we know it's worse, but they can always keep changing it. And the main people that are watching this, they don't know, because no one's really going to follow this because it's not interesting to them. So it's easy. When no one's paying attention,
follow the
it's
incentive,
easy.
man. There's no incentive to follow it unless you're, willing to hold your own assets and do your own research and do all the things that we're all here to do right now, for sure.
Attention's in the details.
That's true. By the way, to finish off some of the data that we got from the meeting, this was one of the fun meetings in my opinion because we do get the projections worksheet here. I do apologize, it is a little bit small, but let's try to zoom in and take a look. So one of the big notes is they projected that change in real GDP actually went up. So the June projection was 1.4. This is calculating for inflation as well. But they're now projecting 1.6. So they're expecting higher growth, unemployment, the same, inflation, the same. But here's the big one. This is part of what's going on here. 3.6 was the projected federal funds rate at the end of the year. Back in June, they had that projection at 3.9%. So yeah, that shows you the change and why they actually decided to make the cuts here. We flip over to the old dot matrix. You can kind of see there's two clusters that we got going on. One was 4, another was 3.5. Bit of a big jump there. But then again, if we kind of go down, this is where we get into the nitty gritty. It's slightly hard to see, but the dotted blue lines are the June projections. The solid boxes are the current projections. So it's a little more spread out previously. Now it's more solidified around that area for GDP. Interesting one for me is if you jump down to, again, what pretty much is that dot matrix about what they expect to see as the federal funds rate or the interest rate, is that, again, this is even more clear. There are very clearly two camps that are staying pretty consistent but shifting, and then it's just a question of who kind of has a better point at the time. So our old projection, we had the group at the higher end and the group at the lower end. Current projections, still of the group at the higher end, still of the group at the lower end. And then we also do have one person over here that's saying the rate needs to be 2.9%, which I salute you, sir, for being a bold person speaking your opinions, but you might be a little off the mark on this one. As we get further down the line, looking at 2026, it starts to normalize and we see that more distributed bell curve pattern going on. But still, at the same time, the general consensus is sitting around that 3.6, that 3.75 area. And the overall mean is a little bit lower at about that 3.5%. So, yeah, if you have a chance, take a look at the data. I think it's fun. So hopefully you guys at least get something out of it yourselves. Gentlemen, any interesting tidbits you pulled out of that one?
You know, I just pulled up a very simple, just the M2 money supply chart in TradingView, and then start it in 2020 and draw the price range to today. And it's a 45% move in the supply. And so you get in very quickly to the argument of, does the money supply affect inflation, right? There's two very strong old schools of economics that have argued about this for hundreds and hundreds of years. The people that pull the levers and the people that run the Fed tell you that this money supply chart is not an accurate representation of inflation, right? They're going to give you the numbers that you just gave. And so it's a curious little thing to analyze, you know. And when you look at, to me, I am not a financial analyst, right? I didn't go to technical school for this stuff. But what I would say is, when I go to the grocery store and I think about prices from 2020 to now, 40% seems a lot more accurate than 15% in terms of the increase of the cost of living that I and everybody else has experienced. And so, apart from the pie in the sky, like ideals or concepts, right? The functional reality on the ground feels a lot closer to that 40% number than the 15% number that they would report over the same amount of time.
Yeah, that's very true. When it comes to the inflation and the prices in particular, inflation is the thing that we measure, which is the rate of change, but prices is the thing that we see on the day-to-day basis. And the unfortunate reality is that they just don't go down. Or if they do, a lot of people call that a very catastrophic thing. But I think the average consumer might say that, yeah, I would appreciate if my gas, eggs, and bread was a little cheaper. But yeah, folks, it only goes up. I'm sorry, but that's the world that we live in when it comes to that. I guess one final note I do want to interject when it comes to the Federal Reserve meeting that we had. We did talk about how there were not as many jobs added and that the job market is not looking too hot. It does not mean that people are getting fired at an exorbitant rate. What it does mean is what they talked about, which is that it's low firings, low hirings. We've talked about this on the channel as well for a good bit now, but really the last big round of layoffs we saw was back at the beginning of 2025. Since then, really haven't seen any, but the story's definitely changed, which is that the job market is rough out there. I'll say that much. Recruiters are saying this is some of the most competitive it's ever been. People are getting those crazy lowball offers, and also the availability is just low. So that's really what we're seeing here, is that it's not that people are getting fired and losing their jobs. It's just that people that have been losing jobs or looking to job hop are very unable to find new jobs, which is why we're getting to the situation that we're getting in. So if Jerome Powell is entirely correct and their plan works out perfectly, well, theoretically, what we should see is maybe another rate cut or two and find out where that nice little balance is, or his neutral rate, R star, as he likes to call it. And that should be that perfect level where it actually incentivizes people to start opening businesses and start opening jobs again. That's pretty much the bottom line for it. So until conditions change, pretty much expect that to be the story until we get a notable correction. Gentlemen, are you guys seeing anything else differently out there on the ground when it comes to jobs?
Yeah, I can certainly tell you, IT fields and areas like that are down heavily. There are actually some big contractions that are going on across all the big main tech companies and firms. They're cutting back significantly, and companies feel like that they can weather that storm, because everybody keeps thinking this AI is going to be a silver bullet to kind of help offset costs, and they're going to be able to leverage it. But I think people are getting way ahead of themselves. Kind of feels like the dot-com bubble all over again with AI. Don't get me wrong, AI is going to be amazing. It's going to disrupt tons of different areas. I just think that too many companies are thinking, I don't think they understand that you still have to have your house in order and things structurally sound before you can start leveraging AI to do some of these grandiose things that you think that they're going to do, certainly in the tech industry. You'd be surprised how many tech companies are simple software development life cycles systems. They're just not in place. Poor practices, things that have been neglected for years. So this is why smaller companies tend to outpace the larger cap companies in those areas. But the job sector certainly is been cooling off a lot, and people are just not hiring that much. Now, typically during these downturns, even though they might say somebody like, I don't know, I'm just going to use a large cap company as an example, say Microsoft, say they come out, they lay off 7,000, 10,000 people. I mean, in all grand aspects, that's maybe 10% of their employees. It's not, it's the cogs or it's the low performers that they tend to trim off. Unfortunately, it's sad, but true. But the other big factor that I think is interesting in the labor market is that the fact that H-1B visas being re-signed by Trump about causing them $100,000 for those sponsors now for the visas. So the H-1B visas, which go towards foreign workers that come to the United States to work, they have to have a sponsorship. And now they're saying that sponsorship is going to be $100,000 a pop for each person being certified. Not to get all wonky with this, but it's a long process. So if you're coming from China and India, the wait process to get your visa might take 15 years. Just kind of put a bundle on that. But if you're from someplace like Sri Lanka, it might take you 3 months. I'm just giving it because it's all based on numbers from which country. But India has a huge influx of people in the IT sectors. So this is going to disrupt it in some shape or form. Is it going to affect the large cap companies? Probably not, because those firms and those big, tech companies will still use them. And they use this because it's a manipulation to the balance sheets. Full-time employees are priced differently than contractors. So contractors are less long-term and they're more a variable costs than a fixed long-term cost. A lot of companies in Wall Street do this little finagling with how they do their overhead costs. The reason why I'm saying all this is I don't know if that's going to disrupt too much on the contracting side. If anything, I would say that's probably going to stay the same. I don't see there's going to be a big flux of new full-time employees coming into different companies. I think they're going to try to keep using AI to kind of offset that and just make people work twice as hard. A very simple example would be like when Seattle, Washington raised the for waiters and waitresses, they increased the minimum wage to $15 an hour. All those companies did was they just cut their staff in half and like, okay, yes, you guys are going to carry the load. And that's typically what happens. So from the labor market overall, I don't see a lot of hiring, but I see a lot of companies trying to work every angle they can to still get the work out and still try to run at
Yeah, that very good points. I personally don't think we've seen the end of the H-1B saga by any stretch of the imagination. I would imagine there's going to be a lot more coming out about that, especially since the immigration topic when it comes to the labor force has been a hot topic for this administration. And I think that one's going to continue, and we're going to just have to roll with the punches on that one. But yeah, the AI question even got asked to Jerome Powell in the meeting. Overall, he was like, yeah, it's fantastic, but he thinks it's overblown when it comes to the effects going on. So I think I'm kind of there with Jerome, which is that, are we seeing the effects of AI? Yes. Do I think it's a little overhyped? Yes. I think my favorite meme clip that I saw from this weekend was somebody was filming themselves in a drive-thru, and their total on the screen was coming out to $1,200. And he was like, hey, can I talk to somebody? And then the machine said, yeah, sure thing. And then it just started doing the recalculating or thinking or loading screen. And then it pops back up again, but it has a new number, which is $15,000 this time. And he's like, hey, yo, what the?
Well, we'll say this though, in the AI industry, I look at it no different than the invention of the typewriter, the invention of, the internet, computers, so forth. I mean, there's always advancements. I'd say if anybody who's in any industry that might be impacted heavily with AI, I would get out there and start learning it quickly and don't fight it. It's real simple. The people who know how to use that tool to do whatever profession you're in is going to set you from the rest of the pack. It's one of those things. If you can adapt and use it, you're going to be more valuable. It's that simple.
Very true. Very true. Tell you what, gentlemen, let's go ahead and shift gears slightly. So let's go from the macro stuff to the crypto stuff, because that's what we're here for. We are primarily a crypto focused channel. So let's take a peek. All right, Bitcoin, what are you doing? All right, we're sitting at $112,000. Yes, that is a very large red candle right there. That broke through the 20-day and the 50-day moving average. I pulled up the 111-day moving average because I wanted to see what it was looking like. But to be honest with you guys, overall, this market, the 111-day moving average, really has not had a whole lot of correlation. So let's go ahead and do what we usually do, which is flip it back to the 200-day moving average, which is our long-term momentum indicator. And look at that. We're still well above it. All right, so what's going on here? Let's zoom in significantly. So this nice little candle right here, that's Wednesday. That's the day that we had the Federal Reserve press conference. Since then, we went up slightly, but largely down into the right. And more importantly, in my opinion, we broke through 2 moving averages, which people were hoping might have been acting as some support. Did end up with our swing low here at $112,000 for Bitcoin. One of the there's 2 numbers that have been really floating around there for probably the last 2-3 weeks, which is 117,000, 113,000. That has appeared to be a bit of the range that we're looking at. 117 is pretty much right here, coinciding with what was the top before we peaked up and went back below. 113 is pretty much these 2 wick candles here that we're looking to create some sort of support. Well, we've broken down through the support, so the question is, what's next? And it appears that the next resistance area is going to be probably down here at about this $107,000 area. That is the start of our 60-day cycle, which we're on day 22, by the way. So for 60-day cycle talk, there's still a lot of ways to go in this cycle. A lot of things can happen. In my personal opinion, I do still happen to think that we will see a new higher high for this cycle, especially considering where we are in the overall 4-year cycle when it comes to Bitcoin. But if we go ahead and take a peek down here at our RSI, the relative strength indicator, yeah, we've broken down pretty low. Went through our moving average on the RSI, and now we're looking to find a low that is hopefully not much worse than this old one we had right at about 43.5. So overall, the indicators are definitely showing that sentiment is down for sure. Last night when I was on DJ Roundtable with Will, I was playing crystal ball with him, and I said, what do you think the fear and greed indicator is at? And he's like, I don't know, probably right in the middle, slightly below it. And he was spot on. It was at 47. So today, let's go ahead and take a peek. Why not? 43. So for allegedly being at the darn near top of a bull market, is 43 where you expect sentiment to be for this part of the cycle?
You talking about is that at 43 a good number for being calling a top? No, I would consider a top more in the upper 90s. But
I would largely agree.
Yeah, have we gotten anywhere remotely close to that? No.
We did hit 94 on the 22nd of November, but that's
been a while ago. That's a while ago,
yeah.
man. Yeah, and no.
Fair enough.
All right, I don't want to step on it. You're going to dive into more TA? Okay, so here's my take on this. Go ahead.
Okay, go for it. All right. Well, I'll pull up one more thing that we did want to talk about, and it's something that's important. So we did have the big red candle at a time when we just got interest rate cuts. We've been talking about it pretty much all year. When we're going to get interest rate cuts, I think a lot of us were expecting the market to go up. So if a lot of people are expecting the market to go up, what might they do? Is the answer open an options contract and go long?
Correct. 100%.
If the answer is yes, well, a lot of people did that. And flipping over to CoinGlass for our liquidations, we, no, that's not what I want. This has been updated. Before I pulled up the stream, this was the single largest liquidation event that we've had all year. It hit $1.8 billion in liquidations, and $1.5 billion of that came from longs. So yeah, a lot of people got wrecked on this one.
The 24-hour wrecked. I didn't realize it has wrecked right here on the chart. That's pretty funny.
Yeah.
But go ahead. No, you finish your thoughts. Yeah, sorry.
Let's look at the chart. Gentlemen, is there any outlier on this chart that you would point to? And is it the giant green candle on the end indicating that $1.65 billion for longs, only longs, got liquidated across the crypto assets? Yeah, that's a lot bigger than anything else that we've seen lately. Oh my gosh.
On either side.
Yeah, but here's the thing. We've been seeing this trend we've been following this trend for a while. And you overlay the TA, you overlay the fib levels, you overlay, everything that we do, and then you overlay with the price where the most liquidation is going to occur, whether it's on the shorts or on the longs, and the price always gravitates towards there consistently. I mean, it's at the point now, I would just bet money that price is going to gravitate wherever the most liquidation is going to occur in the short term. It's been consistently the trade. I mean, it's been an easy trade in the crypto market. And it's almost like, how do I put it? We're in a very, very early TradFi crypto experience right now. Spot ETFs for Bitcoin and Ethereum. We've talked about this. And this is still kind of this is where crypto meets TradFi. Crypto folks are not used to TradFi with all this money that can just snipe massive amounts of bags. It's not even a challenge for them because it's not like they're fighting amongst themselves. They're sniping a lot of money because it's simple. It's still kind of a mature. Yes, Bitcoin's more maturing. I understand that, but still it's a very immature market. And that's why you're seeing these. It's been the trade. You could almost I mean, we could almost go on this thing and tell you, okay, based on this is where the price is going to be probably, I don't know when, but it's going to hit that price at some point because they're going to take out all that money. So you're seeing that. And then I think the fact that, and we even tweeted it in our channel, in our Walk the Block channel, our members, we literally were saying in there, at least I know I stated it in there. I said, don't be surprised if you see a pullback once the rates come out, because it was so baked in. Everybody, it was almost a formality. It was just, that's all it was. Everybody, you can call it sell the news events or whatever you want to call it. But I wasn't going to be shocked at all. I expected a pullback. We all expected that September was going to be kind of a lull market, but it added up very well if you think about it, right?
Absolutely. That was one of the things that we even heard from Jerome in those clips, was that he was saying that he thought the market had already priced in that quarter-point cut.
Well, and look at the stock market. He's not thinking about crypto. It did.
That's true.
S&P's at all-time highs. He was correct. I mean, compared to our relative size is astronomical. And this is a testament to your first point of, I don't know if you have the liquidation heat maps I sent, but those really show the same story you were telling with that other liquidation data list, and even more so in Ethereum than Bitcoin, I would say. If you look at the liquidation heat map, Bitcoin has another leg down to clear the rest of it. Ethereum has cleared it all, and so right now, this moment, for the short term guys, I'm more bullish on ETH because it's been more cleaned out in terms of the active open interest, and so there it is.
Me as well, sir.
Yeah,
I second that, Dave. That's why I rotated out of my gold positions into ETH today.
Nice, congrats, dude. I think that's a great play. Yeah, if you look on the wick today, or it really was midnight, just about. So what I would love for us to do, if you'll examine here, we've cleared out almost all of it, right? We've got some more bands just south of 111, and another small band down there at 108. If you'll flip it to ETH USDT pair, you'll see the difference. So it's going to be the same time, same wick, but look how far down it went, right? We wicked down to just about $4,000, and we've got just bare air under that, right? Complete clean out of all of the longs on the Tether ETH pair. And so, yeah, look, this picture is why I'm more bullish on ETH in the short term, because I think provided that the greater macro market doesn't suffer, right? We continue to see S&P push to all-time highs. We continue to see the Russell, continue to tap all-time highs or hang out in that zone. I think you'll see ETH outperform from here, but that's just me.
I got to ask a question though. So it's interesting. I mean, I have my theory, but the crypto market's been down since that, like you stated, yet traditional markets have been going up.
Well, BTC hasn't been. BTC made all-time high. That's the thing. We've had a bifurcated market, right? So the blue chips, your Magnificent Seven and stocks, and your BTC and crypto have crushed it. And then your Russell 2000s, your small caps, whether it's crypto or stocks, have suffered.
Well, no, I'm talking about short term. Since the rate cut, Bitcoin's gone down, ETH has gone down.
Oh, sure.
S&P 500 and the traditional markets have gone up.
Yeah. Well, they're easier to move, right? You can't move crypto markets like you can the S&P 500, right?
It goes back to what I was saying. It's still an immature market still, and it's easier manipulated because of mature market. And I also think, it kind of feeds into the narrative that a lot of people are, I'm not gonna say a lot, but it seems like there's a lot of people that are saying, the market's this 4-year cycle's over. So a lot of people are taking their profits and leaving. And I think that's another thing that kind of feeds into it's just another, it's another camp that you can throw in there that went out there, they're leaving and saying, okay, the 4-year cycle's over in their minds. And this is a great time to take it because September was typically a down. So let's go and take profits now and let's call it a day. And I think that's what you're saying. I think it's just another group of camp that's adding to the downturn is what I'm getting at.
Could be.
I get what you're saying. I question who exactly is doing that, because believe me, the argument makes sense. I think there are some folks, like famously Bob Lucas, thought that we topped out at about 72,000 Bitcoin and ended up selling a good bit. So look, even the Godfather gets them wrong every once in a while there. But
I agree.
By the data, I mean, if we go over and we've flipping them back over to CoinGlass, looking at our ETFs here, ETFs still pretty decent inflows there coming in. Granted, we don't have today's candle on there, which I would imagine is giant red, but overall ETF flows going in. Let's take a look at the Ethereum ETF. Again, going in a little bit slower, but still definitely going in. And by the way, gentlemen, in case you didn't see this one, there's a new button at the top, by the way. Solana ETF. That's right. This one has been live for about 2 weeks now, but even stuff's going in there. So I understand the argument that people might be calling the top a little bit early and just trying to secure profits while they can. But I got to say, I think that I've only seen more of the narrative that we're going to get the extended cycle when it comes to the Bitcoin 4-year cycle. Either that or people just outright proclaiming it's dead. So
yeah, look, I think you do have people out there saying that, but who are the people saying that, right? The people saying that are people who've been in crypto for at least one cycle previous, if not 2 or 3. The number of people that is the case for versus the number of new traditional finance people who are getting new eyes on it for the first time, combined with the clear liquidation heat maps, right? I would chalk up this move much more to, namely, CZ, Binance, cashing in on liquidating folks before we run, but taking advantage of the fact that new institutional players are slowly accumulating. And since they're accumulating, they've got leverage on. We've shown the net shorts on Ethereum and how they've been pushing new all-time highs perpetually since last February, no pun intended, since like last February. And so, yeah, I think when you look at the relative market cap and the size of the crypto industry as a whole, and then you look at these new institutional players who now have an interest in it, and only you're going to get more interest as things like the Genius Stablecoin Act passes and as things like the ETF staking bills pass, which I think until those two things happen, you're going to see this just liquidation hunt. Wherever the liquidation is stacked, price will move there because that's the most incentivized move for the chart. And then once these bigger players who are holding the price down with leverage with one hand and accumulating spot with the other, once the rules change to where they are further incentivized to let the price run on the accumulation that they've acquired rather than to keep it down, that's when crypto will have the bull run that we're used to seeing, right? For the rest of the market and not just BTC running, right? We've had a prolonged period of time of a quote unquote bear market environment for crypto, even though it hasn't been in a bear market for stocks, for traditional stocks. The past 3 cycles, BTC has been the only thing to run for as long as we've been in the bear market, and BTC has dominated this whole cycle all the way through. And so I am squarely in the camp of whether it's going to be, and I said this in the Degen Roundtable actually in a voice note today, of like, we might have this like incredibly short, protracted, and volatile blow off top for the rest of crypto to fit into that 4-year window, or the 4-year window is going to get stretched or broken, and we're going to see a new paradigm emerge, and the folks that have entered the market have manipulated and taken advantage of that 4-year cycle, and we'll see a new trajectory. And so that's, if we want to point the finger at who's to blame, to me it's the liquidation, right? It's the guys hunting the price, the value of the price moving in the short term because it is so light and easy to move.
That's true. And by the way, both you gentlemen have alluded to this topic, and it's a bit of an advanced topic, but for the folks at home, colloquial, it is known as maximum pain theory. So shout out to Charlie Miguel. Those guys run the Citadel, and they have a weekly newsletter. One of the things they track constantly is this futures market or the options contract market, and they utilize maximum pain theory. It's the idea that you look for the price point that would cause the maximum pain in the market, meaning not trying to ensure that the market isn't getting away with too much free money off those options contracts. And it usually, especially during critical times when these options contracts expire, that is specifically when it's hunting for these prices. So we are 22 days into September, so the monthly contracts are expiring pretty much here at the end of the week, effectively. So that is an arguable reason, as what we've been talking about tonight, about why it appears that the market is trying to seek out these liquidations effectively. Maximum pain theory. There you go. Shout out to the Moongangers. Y'all are some advanced folks over there, and we love you. Alrighty. Well, tell you what, let's flip it over to what could be a little bit of an inspiring article, shall we say. Coming to us from Cointelegraph. The Uptober rally is questioned as crypto markets turn red 9 days out. Bitcoin dropped to a 12-day low on Monday despite analysts hyping up the Uptober rally potential, though not are all confident that next month will be up only. So what this is referring to is something that we've pulled up previously. If you go over to CoinGlass, you can see what they found here, which is that if you track Bitcoin performance by month, there are some trends that happen. And largely September has been red, but October has usually been very green. So we are now 8 days out from October. And if September is usually red, well, let's see where we started off the month for September. Let's flip over here. Yes, the start of our 60-day cycle, meaning $107,000 Bitcoin. Is there a possibility we can get down there? Yeah, for sure. If we drop below that, would it break the 60-day cycle count or indicate a cycle going towards the downside? Yes, which would kind of be counterintuitive for an Uptober event that the article here is talking about. But
if you recall, the last band of liquidation on that BTC chart was just at or right under 108K.
Exactly. So it could signal a few things. A, price is going to hunt down there for liquidations, or it could also find support down there as well. Both of those do still present the potential positive case for October being a largely positive month. And again, I've alluded to it at the beginning of the show here tonight, which is that, oh gosh, it sucks when you forget your thought.
I'm sorry, I cut you off, brother.
No, you're good. That's on me. Whatever. September is looking decent right now. Could look worse, but October could be the thing. Thank you. The 4-year cycle. The 4-year cycle is running a bit long in the tooth. So based on that case, in combination with historical trends, it is a decent case to say that October does have a pretty strong case for going towards the upside. So if that's anything, and we flip back over to our Bitcoin chart, yeah, it means that largely this could just be exactly what Dace was talking about. This could be a volatile correction towards the downside following a major macro event that people have been trying to price in for a long time, aka buy the rumor, sell the news. There you go. We saw a very similar story back when the Bitcoin ETFs launched back in January of 2024. Bitcoin hit a high of about $48,000, and then it dumped all the way down to about 36. So that's a sizable correction of about over 20%. And then we all know what happens after that, which is it went on their record historic run, which has never happened before the halving event, and it went all the way to a new all-time high of about $72,000. So is this a downside correction? Yes. Is there possible downside correction to this? Also, yes. Does it eliminate the bullish case for what is largely to be expected at this point in the cycle? In my opinion, absolutely not.
Well said, sir. Couldn't say it better myself. I agree. I think just to circle back, I keep harping on it. I think when legislation changes, you'll see the environment change. And until then, it will be more of what we're used to, of folks accumulating, leverage games being played back and forth while big players stack up what they can.
Absolutely. And by the way, we wouldn't be Walk the Block if we didn't pull up the weekly obligatory ETH strategic reserve chart, which, by the way, again, to help strengthen the case that people are still buying, let's go look at our favorite. Bitmine, what have you been up to? Well, in the last week, they bought 850 million Ethereum and then tacked on another 345 million. And today alone, $1.1 billion purchase of Ethereum. So are people out there still buying in large chunks, by the way?
Yeah, what's their percentage of holding right now?
They're sitting at 2.4 million Ethereum. They currently have, what is it? Let's see.
2% of the supply.
They are targeting 5% of the supply, and they're about 40% of the way there. So they are at 2% of the entire supply.
Yeah, I mean, I know they love the dip. They all love this dip because they're actually getting it for much lower prices. They're going to
yeah.
buy regardless of the price. At least that's how it certainly feels.
For the traditional folks who are familiar with MicroStrategy and the MNAV structure that they're running, BitMine is running the same thing, right? Where you've got a company acquiring crypto, putting it on their balance sheet as their treasury, and then folks are trading their stock. And you've got basically a premium for, hey, you can just go buy Bitcoin, or you can buy shares of us, and we're buying the Bitcoin, right? We've got this giant bag of it. BitMine's current MNAV is at 1.55x. MicroStrategies is at like 1.2 something. So you've got a higher MNAV with BitMine right now holding ETH than with Strategy holding Bitcoin, even though that's the big one in the in the news today. You said our favorite. Speak for yourself, my friend. The Pulse Chain.
That's true.
Pulse
That's true. We
Chain
love that
backed
one.
treasury.
We love
That's
that
my
one.
favorite personally.
I was
That's
thinking the same one. I was thinking the same thing when you were exact same thing. And
Oh,
just to put
gentlemen,
it in
don't you worry.
perspective- Well, just to put it in perspective too, just to piggyback off what Dave's saying as far as like, what's the better investment? I mean, Ethereum is still lagging Bitcoin dramatically in the price from what we saw in 2024. So Ethereum has then more of a narrative, starting to have more adoption, and it's got more runway to the upside if these narratives actually hold true and people are going to start accumulating Ethereum, because Bitcoin's kind of long in the tooth for the investment. But Ethereum, the key here is, and by the way, I wanted to tell you guys, full disclosure, I do own some of the Grayscale ETF, ETHE. It's Grayscale, and they sent out letters to holders because right now they're going through a voting process where they're going to start providing the trust with the ability to stake the ETH held by the trust and receive consideration in relation thereto. So they're going to start staking it and starting to give out much like a dividend is what they're pushing to go for. So there's another reason why. It's another narrative. And then of course the whole thing we always talk about, you can build on the smart contracts and things like that with Ethereum. It's just more narratives to pile on why Ethereum is such a better investment. Personally, from my opinion, it's a much better investment than Bitcoin at this period in time. And if you do believe in the 4-year cycle and the rotation trickle down effect from, going from Bitcoin and trickling down to Ethereum and the large caps, then Ethereum also feeds in that narrative as well. So Ethereum has much more opportunities, I'd say, than Bitcoin. That's my 2 cents.
Argument makes sense to me, and by the data, I would say it checks out. The Ethereum Bitcoin ratio has definitely been climbing. Bit of a pullback here, but overall, I think you're entirely correct. And it's based on all the stuff that you guys have been following very heavily throughout the first half of the year, whether it was the massive short selling, the L2 issue going on there with not burning enough Ethereum fees to gas to lower the supply. All that kind of stuff's definitely factored into it. So as it stands, yeah, Ethereum I think does have a little more upside.
Tell me, Dace, you got to have it. Where's the Ethereum short chart? Where's that thing at? Because that's the thing. I mean, that's the short squeeze of all short squeeze. It's just that something's going to trigger it. I don't know what's going to trigger. Something's going to trigger it though. But I'm still in that camp. Sorry, I'm not going to let up. That's just crazy, the amount of short interest.
looking to see if I can find it. It always gets fed to me on my X account.
Yeah, that's
so I never
fine.
actually pull that chart. But if I can find it, I'll post it. You should actually you guys should come join Walk the Block and come see it in our Telegram when I post it in there. Zena's already got the website up. Tell them, Zena.
That's right, folks. We would greatly appreciate it if you do the YouTube pleasantries, like, comment, subscribe. That will get you up to date with everything we're doing over on this side of the fence, where we're going to be streaming every week, Monday, 8 p.m. Eastern time. But if you would like some more juicy info, streams, which are pretty much darn near every day, and the closest and easiest access to us for all your fantastic questions and the learning content we're trying to put out there, head on over to walktheblockndf.com. That's where you can find our membership page. And, well, we like to say that the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together, private mentorship, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. Well,
Hey, Zena, did you want to bring up the concept we were talking about on the green room about what we see that I was telling you about how treasuries are starting to fall out of favor as far as the conservative held for long-term investors? Certainly some of the hedge fund companies are starting to advise clients to start moving away from treasuries.
is this your card?
Yeah, you could bring that article up, but before you dive into it, I'm going to give everybody kind of like the bluff of what's going on here. So China, Russia, and other countries, they're just not buying treasuries. They're starting to pull back heavily on treasuries. And what you are seeing them do, you're seeing them buying Bitcoin, other cryptocurrencies, and you're seeing them certainly still buying up gold. One other area then the other thing that you'd have to see is that
Tracker, you're breaking up us on a. All right. Well, Tracker's gonna figure out the connection real quick.
I'm here. I'm sorry about that, guys.
Oh,
all right.
good.
So what I'm getting with this is that the Bitcoin and gold, they're starting to get bought up. U.S. Treasuries are not getting purchased as much. So you're seeing those occur. You're seeing also the precious metals, not just gold and silver, starting to rise dramatically. I mean, silver's up 25%, platinum's up to 57%, gold year to date is up 36% year to date. And why is all this happening? Well, you have all the uncertainty with geopoliticals. You have inflation with the economies. You have weakening U.S. dollars. Obviously, what we keep talking about, central banks keep cutting or keep creating more weakening of the dollar. Federal Reserve's cutting, like we're seeing right now. So other countries are not buying treasuries. And what used to be in favor for owning that 60-40 rule, like you should own, depending on your risk tolerance, you own a certain percentage of stocks, then you own a certain percentage of treasuries or bonds. That's starting to fall out of favor dramatically. And what you're starting to see, a trend starting to change. Now, this might be kind of a new trend, but people are starting to advise their customers, instead of that, you should be owning gold. You should be owning some Bitcoin, depending on your risk tolerance, of course. Obviously, Bitcoin's very volatile, but gold has definitely been the trade. Gold doesn't just keep going up forever. There will be pullback periods, and if you look at a traditional market, you do, but it's been straight up for gold. So all the reasons why we keep telling you is you're starting to see hedge funds companies starting to advise their customers to start going this direction and not owning U.S. Treasuries, because this trend is not going to change. It's just not going to stop because of the irresponsibility of the physical, the federal printing and everything we keep talking about. It's just feeding into this, and other countries are just not buying into it anymore, and it's fallen out of favor dramatically. So you're seeing that. Something else that's also starting to fall out of favor. It used to be you own a money fund, which is just AKA ETFs that are basically tracking the U.S. dollar. That's starting to fall out of favor. People are starting to be advised to own ETFs that are mutual funds that are tied to gold specifically, or other assets that are going to hold up better against inflation. Cash, you're going to just get destroyed for in cash. If you're holding gold, just in the last 2 months is up 11%. Not saying that those trends are going to keep happening or keep going up, but if you're trying to find a way to balance your portfolio, they're trying to balance it more correctly, and they're actually talking to people that are older. In this case, people that are moving towards, I don't know what to call them, boomers, but people that are getting closer to retirement, or that, Gen X generation, or the generations that are kind of leaning more towards a conservative portfolio. And they're telling them 60% stocks, 30% gold, 10% Bitcoin. That is starting to become a trend that is starting to unfold. This isn't just in one kind of areas. People are starting to get more aggressive in these certain areas, because if you got your own treasuries, you're not even going to keep up with the inflation. You're going to just keep losing money there. And if your ultimate goal is to preserve your capital, you can't stick it into a money market account that's holding cash. It's going to keep going down because of the inflation aspect. So they're trying to find what's holding up, and what's holding up is precious metals, specifically gold, because silver and the other ones go into more manufacturing and things of that nature. So gold is definitely more of the preserving piece of it. But that, along with Bitcoin and potentially other cryptos, but right now Bitcoin is really the only one that's really in favor currently. But depending on your risk tolerance, those levers are kind of the two, the gold and Bitcoin. Personally, me, I have been holding on my dry powder in gold ETFs, rotating out when I can into other cryptos as opportunities, and that's paid very well this past year. Now, well, that, like I said, it's not going to stay true consistently, but I would rather be in that play than owning cash, and certainly in owning treasuries and bonds. Now, some other things I was digging into. Other big, large hedge funds, they necessarily can't just say, if they wanted to, they would love to say, I'd love to dump all these treasuries and buy more crypto and buy more gold. But here's the problem. There's almost like an agreed upon in the TradFi industry that they've got to prop up treasuries, because else the entire, we'll call it a Ponzi, I guess is the best way to call it, will come collapsing down. So they have to prop up the U.S. Treasury markets. They have to keep it up. And there's almost an agreed upon that they have to do that. And It's almost like unspoken that they're going to do it. So would they move some of that money into other things? They would move things into other things, but they're going to still have to keep buying treasuries because of how big the treasury market is. I don't want to get into the whole derivatives market and everything on that scale, but it has a lot to do with that as well. But I would like to know your thoughts on that one.
No, that makes sense. It actually coincides very nicely with a clip that we played last night about Brian Armstrong was saying that the rest of the G20 nations are actually getting pretty serious about starting up their own crypto strategic reserves. So it just doubles down on the point that you're saying there, which is that traditionally those people would be holding U.S. bonds and other treasuries, but instead they're looking at other avenues. And it looks like crypto is really creeping into that market. Gold has always just been like the go-to. And oh gosh, especially over the last like 5-10 years, it has just done nothing but go up and to the right. Gosh, I remember the good old days when gold was like sub $1,500. Now we're approaching 4,000. So the track record speaks for itself on that one. And I'm not surprised that we're starting to see financial investors start to change their strategy when it comes to even people going for a very, as you said, conservative approach, because they're at this time in life where they're not trying to make money on it. They're trying to live off of it. Therefore, don't try to risk what you already have. Just hold on to what you have and spend it as you go into retirement. But yeah, the data points are converging in my opinion. Alrighty. Tell you what, gentlemen, it is a little past the top of the hour, so let's go ahead and get on with the rest of this. Tracker, where can the folks find you, and what do you got going on in the near future?
Here on Mondays, and of course in Walk the Block Telegram. It's been a little bit quiet in the last week or so, but we're still what I'm spending more time doing right now is just researching and seeing what everybody else is kind of doing and getting the temperature of what we feel. You definitely catch us here on Mondays. Catch us also in the DGen Roundtable chat rooms, but in Walk the Block, that's where we're going to be finding us. I'm looking to just basically stay on top of the market, see what's going to go on like everybody else. Looking to make moves. Personally, I still have various other assets that I'm in that I would be looking to rotate into. More pullbacks, not a problem. I'll be more than happy to rotate them in, and I will be looking to rotate into gold on those opportunities to take profits when that is needed. But right now I'm still going to hold tight, and I still think we're going to be moving more to the upside. I think this is a nice shakeout. It's almost like telegraphed, if you almost want to call it that.
Makes sense. All right, Dace, good sir, where can the folks find you? What do you got going on?
You could find me on X and on Instagram at Dace Northall. And also in the DGen Roundtable and Walk the Block Telegrams, active in all those places.
To hear it. Folks, you can find me on X and Instagram at ZenithDI, but more importantly, you can find all of us in the Walk the Block Telegram. Again, if you would love to join, we would love to have you. Head on over to walktheblockndf.com, find our membership tab, and that's how you can do it. Outside of that, though, well, it's definitely been a big week. Maybe not the ways we expected, but we're going to continue to be watching it and see what's going on and waiting for the good old quantitative easing to see if Jerome Powell has any interest in pumping our bags. But outside of that, that is all we got for tonight. So, ladies and gentlemen, thank you so much for joining us. We will catch you guys next time. Good night.